So thank you very much to Ingrid and Bjorn for including my paper in the program. I'm very excited to be here. And the paper I would like to present today focuses on fintech lending, specifically in the context of the US credit market, and the US consumer credit market in particular. So peer-to-peer lending has been one of the most successful and recent innovations in the US. And although we haven't talked much about it yesterday, I'll give you a brief primer of what it is in a couple of slides. So the US consumer credit market is a large market. So we're talking about around $3.5 trillion US in 2015, probably much larger today. However, there are a number of imperfections in the US credit market. Specifically, unlike most people in Europe, Americans borrow a lot on credit cards. So the median credit card debt is around $11,000 in the US. And the stylized facts in that market is very high interest rates on that credit card debt. And despite that fact, people still hold so much credit card debt. Another imperfection is so-called pooling, when credit card companies and banks charge the same rates to borrowers of different credit quality. And also, some borrowers are so-called credit rationed. It means that they don't get credit at all, or they get suboptimal levels of credit, or at least they get lower credit limits that they wish they could get. And in that consumer credit market, we've seen many new entrants trying to disrupt that market, probably seeing those inefficiencies that they could overcome. Specifically, in the peer-to-peer lending segment only, these platforms have originated around 16 billion of peer-to-peer loans from 2006 up to 2015. This takes around 6.7% of the entire unsecured consumer credit market. So it's already growing to be substantial. And the growth potential is estimated to be at least 150 billion of loans originated per year by 2025. So these platforms are growing and potentially disrupting markets. However, we still know very little about whether this disruption is coming. Are those disruptors, are those enablers, or are those just other competitors in the market? And there is an ongoing regulatory debate, I know not only in the US, but across the world, of whether this fintech lending is actually good for borrowers. Do borrowers overborrow, or is it beneficial for them? And my study provides some evidence in that regard. So the main research question I'm asking in this paper is whether fintech lending, and specifically peer-to-peer lending, can have effects on the broader consumer market, and specifically can change access to credit from other financial intermediaries, such as banks. So there is already some literature out there that studies financial innovation, and specifically financial innovation in markets. However, most of that literature to date focused mostly on the product side, so introduction of new products. Whereas peer-to-peer lending itself, at least in the US, is not a new product. It's the new way of processing information and lending to borrowers. So it's a technological change. There is also a young but growing literature on peer-to-peer lending specifically. And most of those papers, again, up to date, focused on the market itself. So what are the funding determinants in those markets, who gets funded or who doesn't? And only recently papers emerged that try to look at broader implication of that fintech lending innovation. So what my paper does, I look at the technology side of financial innovation. Most of the papers that do look at it focus on the screening technology and how improvements affect competition in the markets or information acquisition. I look at access to credit for borrowers. I also use peer-to-peer lending as a setting to say something about, the broader implications as to consumer credit demand from banks, as to the supply of credit to consumers from again, banks or other traditional credit intermediaries. And the key finding, and this is where I think my paper contributes to the debate, is that peer-to-peer lending seems to induce an increase in access to credit for borrowers from other traditional credit intermediaries. So the results I'll show you today, I'll first show you the finding that peer-to-peer lending causes an increase in access to credit to borrowers. And I would like to emphasize the word causes, because I believe that my setting is very good to identify the effect. I will show you that most of the effect seems to be coming from existing lenders. So it's existing lenders who are updating their belief about the borrower and changing their credit decisions. I will also show you that most of the effects are driven by borrowers who are ex ante more likely to be credit rationed by banks, so denied credit or be subject to cuts in the credit limits, such as borrowers with shorter credit histories and lower credit scores, such as the FICO score in the US. Then I will talk a little bit about the demand for bank credit on the part of consumers. And I'll try to convince you that this is not driven by borrowing patterns, at least that's not supported by my data. And also I'll try to look at implications. So whether that increased access to credit leads to consumers over-borrowing, so defaulting more and having higher levels of debt. So peer-to-peer lending. I focus on peer-to-peer lending as it has been one of the most successful innovations in the lending space in the US. And as the New York Times characterized it, it's a rare thing, scarcely seen in the financial world since the debut of ATM and microfinancing, an innovation to help regular people. So what is it? So basically, peer-to-peer lending is a matching of borrowers and lenders, bypassing traditional credit institutions such as banks. So the way it works, a borrower goes online and fills out a credit application. So the median loan size that's requested is $12,000. So we are talking about smaller loans. And the sizes are from $2,000 to $30,000 US dollars. And also that borrower submits some hard data. What I mean is that there is a credit pool from the credit bureau. This is a centralized bureau in the US that collects borrower information on all payments and defaults and then assigns a credit score, which is called the FICO score, to borrowers. So all this information is automatically pulled from the credit bureau and submitted into the system. After that, the platform verifies the data and sets an interest rate. So it's not completely disintermediated. There is a price setting mechanism there. And APR, which is the interest rate plus the embedded fees, is application specific. So unlike what we see for credit cards, for example, in the US where there is pooling, so many borrowers of potentially different credit quality are charged at the same rate, here this pricing is very, very granular. And APRs range from around 6.4% to 36%. After the interest rate is set, investors come in and they post their commitments to fund those loans. They decide whether they want to fund the loan or not, based on observing the same information as the platform has. So just to give you a rough estimate, per each loan application, around 550 variables are available. So credit limits, different types of credit, credit balances, et cetera, utilization ratios. And also, investors decide how much to fund. They can crowdfund the loan, so they can fund as little as $25 per loan. So each loan is treated as a public security in the US, and it can be split in increments. And also, one thing I want to note is that after the loan is provided, it's reflected on the credit bureau again. So what banks can see, banks can observe the loan being granted to a consumer. What the banks cannot see, they cannot see how many investors funded the loan or what was the funding rate of the loan. And I'll get back to it a little bit later. So what is the innovation behind peer-to-peer lending? So the first innovative feature is this basically direct matching, because it's investors who eventually decide whether the borrower gets a loan or doesn't. And we have that disintermediation of lending. And this has implications as to how hard information is processed. So in the world we were before, bank would collect deposit, pull that money into one pot, and then lend it to borrowers, to consumers. Here, each investor processes that information differently, has its own screening model, and decides whether that investor wants to invest in the loan or it doesn't want to invest in the loan. And there are many investors on the platform, and currently in the US, around 94% of these are institutional investors. So sophisticated investors who can actually write their own models. Another innovation is that all the steps in the process are fully automated, from screening, pricing, to data verification. And that has implications for the screening costs. So screening costs are lowered. And these two improvements may contribute to how credit is priced and how investors lend, how lending is done, and potentially has implications for other market participants, competition, et cetera, et cetera. So this is an empirical paper. My data comes from one of the major peer-to-peer lenders in the US, which is called Prosper Marketplace. So this lender has around 1/3 of the market, so it's a large player. I have anonymized application level data. In the US, since each loan is treated as a public security, those platforms have to disclose that data. And the good thing about it is that it's application level, so you can observe both approved and rejected applications. And another uniqueness of the data set is in its richness. So you have around over 500 variables per loan application. So you know a lot about where those borrowers borrow from. My sample starts in January 2011 and is up to September 2015. And there are 3 features of the setting on the platform that allows me to claim causality and identify the effect of how borrowing from a peer-to-peer lending platform affects credit outcomes in terms of bank credit and broader credit market. So the first feature is that Prosper tracks repeat applicants. Since the data set is anonymized, it is impossible to match it to any other data sets. However, you can observe borrowers who repeatedly apply for loans. They may or may not get the loan on the first attempt. They may not or may not get the loan on the second attempt. But what I need is to observe those borrowers over time. And I focus on those repeat borrowers in my empirical tests, and I do some robustness checks to rule out selection concerns. The second important feature is that the loan amount, so the demand for peer-to-peer loans, and also the interest rates are set ex ante, so before investors come in and commit to fund or not the loan. So eventually, the percent of commitments from investors is what matters for whether the borrower gets a loan or doesn't. And the third feature is that there is a minimum funding threshold, which is 70%. For example, if you want to borrow $10,000 from the platform, investors can commit as little as $25 per investor. So only when the total commitments from investors cross 70%, which is 7,000, only then you can potentially get a loan. And I use that setting in a methodology which is called regression discontinuity design. So who are these borrowers actually? The chart above plots the credit score of the borrowers, called the FICO score in the US. And the blue bars is the scale distribution of borrowers on the platform, whereas the red bars are the general population. And the score ranges from 300 to 850. Borrowers who come on the platform are prime borrowers. So there is a minimum FICO score of 640 if you want to come on the platform. However, the distribution itself is more skewed towards lower quality borrowers. So you have some heterogeneity in the data as to who these borrowers are. Now, these borrowers earn a lot, so they seem to be good in terms of their credit profile. They earn about 2 times as much as an average borrower in the US. They also have a loan credit history and a good history with their current employer. So this is the length of employment with their current employer. However, the median borrower does not own a home. So the median borrower may lack collateral to go for and ask for a regular bank installment loan. Also, if we look at their total debt, these are highly indebted borrowers. So their total debt is about 1.5 times larger than on the median in the US. And if you look more closely at the structure of their accounts, most of these are revolving accounts, which are credit cards and lines of credit, personal lines of credit. And credit card utilization here is quite high. So they utilize actually their credit cards aggressively. And there is I see some evidence that they actually roll over their debt. So they borrow on credit cards. So this is the first result. What I do in this table, I look at outcomes for borrowers who get peer-to-peer loans on the platform versus outcomes for borrowers who do not get peer-to-peer loans, who apply for the peer-to-peer loan but get rejected on the platform. And this is my dummy for getting or not getting a peer-to-peer loan. So I make use of within borrower variation in outcomes. And I include fixed effects in the regressions. And you can see from this table is that peer-to-peer lending is associated with an increase in access to credit by around 2.5%. So I measure access to credit with credit limits on revolving accounts. Why do I use those? Because these are the accounts when you can differentiate between the limit, which is my proxy for access to credit, and the balance, which is my proxy for credit demand by borrowers. And peer-to-peer loans are not part of these revolving accounts. I see a bit of a smaller increase in the number of revolving accounts. And in my further tests, I won't confirm this. So it seems like most of the increase is coming from existing lenders, as the number of accounts does not seem to increase. Now, what is the potential problem with that analysis? Is endogeneity, meaning that borrower risk is unobservable, essentially. We can proxy for borrower risk with characteristics, but this is not a perfect proxy. And maybe the results I showed you just now are driven by those unobservable borrower characteristics. Maybe it's borrowers who are of high credit quality are those who get peer-to-peer loans. And these are the same borrowers who just go to a bank and get an increase in access to credit. So maybe it's not peer-to-peer lending itself, but the borrower characteristics that are driving the result. So to rule out this concern, I take identification seriously, and I look at the setting on the platform that I mentioned a couple of slides ago. So what this graph shows is loan origination based on the percent funded by borrowers. Again, there is a 70% funding threshold, so if you're below 70% at 14 days, you don't get a loan at all. If you're above 70%, you may or may not get a loan because some of the loan applications are further canceled by the platform. And that's why I use a specific technique, which is called local fuzzy regression discontinuity design. What this technique does, it looks at borrowers very close to the threshold, saying that those who cross the threshold might be just lucky that they did. There is one extra investor who committed to funding their loan. So those investors, if they are indistinguishable in their characteristics, are only different because their outcome in peer-to-peer lending is different. So some get peer-to-peer loans and some don't. And the probability of getting a peer-to-peer loan above the threshold is around 38%. And this allows me to identify the causal effect of peer-to-peer lending on a subsample, specific subsample of marginally funded borrowers who are a bit more risky borrowers than on average on the platform. So this is the graphical interpretation of the results. What you can see here is the outcome variable in period T for borrowers who were above and below the threshold in the previous period. So you can see here a discrete jump in revolver limits in access to credit after they cross the threshold. And there are a couple of things to note. So those who are above the threshold get or do not get peer-to-peer loans. So some of them do, some do not. So this does not condition on this. And also in this tests condition on the forcing variables, but there are no other controls. Here are the formal results. So the way fuzzy RDD is executed, you basically instrument a probability of getting a peer-to-peer loan with being above or below the threshold. And then you regress the outcome variables such as revolver limits in my case on that instrumented peer-to-peer loan. And you can see that here peer-to-peer lending causally leads to an increase in access to credit from banks. I do not see, I see little evidence of increase in the number of accounts. And the magnitude is a bit higher because we're identifying out of a subsample of borrowers who are potentially more credit rationed and lower credit quality. As another check, I include lagged controls into my regression specification because when your outcome variable is very persistent, this is what, for example, Lee and Lemieux and other econometric literature warrants to do. And you can see that my results stay. What I also do is I look at heterogeneous effects based on the ex-ante likelihood to be credit rationed by banks. So are those effects different for different types of borrowers? And specifically, I look at borrowers with shorter credit histories and borrowers with lower FICO scores. So here, what this shows, this negative coefficient shows is that the longer credit history you have, the less of effect there is. In other words, borrowers with shorter credit histories enjoy a larger increase in access to credit from banks. Here I split the sample by the credit score. Again, this is similar to the credit history ex ante, so on the first application. And I can see that most of the increase is coming from this section, so borrowers with lower FICO scores. So there is a bit of an outlier here because these groups have very few observations. So what I've shown you so far is that banks increase access to credit to borrowers who get peer-to-peer loans versus the ones who get rejected on the platform. The effect seems to primarily come from existing lenders as limits increase, but the number of accounts do not necessarily increase. And the borrowers with shorter credit histories and lower FICO scores get a larger increase in access to credit. So these results seem to be consistent with the certification and information spillover theories, but inconsistent with theories of sequential lending, which says that when you borrow from the next lender, you overborrow, and that has negative externalities on other competitors. After that, what I do, I explore whether the results may be driven by just borrowing patterns. Maybe it's not information spillovers. Maybe what's happening is that borrowers who borrow from peer-to-peer lending platforms decrease their credit card debt, and that has implications for their credit worthiness. Let's say banks just look at that decrease and increase access to credit because of it. And separately in the paper, I also look at whether the FICO scores, the credit scores improve. You can see that on average, borrowers do shift away from credit card debt. There is a negative coefficient. However, borrowers who are credit constrained here in that marginally funded sample actually increase their use of credit card debt. So my results cannot be explained by just debt repayment. And also you can see that the effects are larger for borrowers who are more credit worthy. So borrowers who are more credit worthy repay more of their credit card debt using peer-to-peer loans. But both groups actually enjoy an increase in access to credit from banks. And I also look at the consequences. And what I see is that borrowers who borrow from peer-to-peer lending platforms have higher total debt. However, I don't see any evidence that they default more often. And just to conclude, I show that in this paper that banks increase access to credit observing a peer-to-peer loan granted to the borrower. And this is consistent with information spillovers from fintech lending to a traditional banking sector. And the takeaway from today's talk is that fintech lending increases access to credit even from other existing lenders. Thank you.